trying to make sense of investing, it can feel like you're just drowning in complicated advice.
Right.
And all the jargon, it's overwhelming.
Oh, absolutely. So much noise out there.
But what if there was a guide, a real classic, that just lays out clear, timeless principles, something to cut through it all?
You must be thinking of Benjamin Graham's The Intelligent Investor. It's pretty much the foundation for so much sound investing.
Exactly. And that's what we're diving into today. We've got some key myths from Graham's book, which, wow, first came out in 1949.
Yeah, amazing how relevant it still is.
And we've also got some commentary from Jason Zweig to help, bridge the gap to today. Our goal here isn't to bury you in information.
No, definitely not.
It's really to pull out the practical stuff, the core insights that can genuinely help anyone become, well, a more thoughtful investor.
Getting straight to what really matters, yeah.
Okay, so let's start with maybe the most basic question. What did Graham mean by an intelligent investor? Because I suspect it's not about having a genius IQ.
You're spot on. Graham was very emphatic that being an intelligent investor has absolutely zero to do with your IQ score or, how well you did in school.
Okay, phew. So if it's not about being some kind of brainiac, what is the key then?
It really boils down to character. Graham stressed things like patience, being disciplined, and importantly, being eager to learn.
Patience and discipline. Easier said than done sometimes.
Oh, true. But maybe the most critical part is having the emotional control to stick to your plan and the ability to think for yourself, not just follow the crowd.
Character over brain. I like that. It feels more accessible.
Definitely. It puts it within reach for everyone, really.
Now, Graham watched the markets for decades. What did some of his early experiences teach him about how these things actually work?
Well, his brush with the Save-Old tire fraud back in 1919 was a really powerful lesson. He saw these huge paper gains just evaporate when the truth came out. Yeah. The big takeaway, even for us today, is that amazing-looking returns can hide massive risks. You absolutely have to do your homework, that thorough analysis. It really drove home the whole boom and bust cycle for him.
And it wasn't just a one-off lesson for him, was it? He saw these patterns repeat.
Exactly. Fast forward decades to 1987. He noted that all bull markets, eventually, they end badly, which sadly proved true with the crash later that year.
Right, Black Monday.
And he also pointed to the downturn in 69-70. That sort of shattered the illusion that you could just buy the top stocks anytime at any price and be guaranteed a profit.
So the market returned to normal, as he put it, meaning ups and downs are just part of the deal.
Precisely. Investors just had to accept that reality expect gains, yes, but also be ready for significant losses.
It's easy to get caught up in the moment and forget that markets don't just go straight up.
Absolutely. And what's really striking is, despite huge upheavals like World War I, Graham saw that if you stuck to sound investment principles, historically you got sound results over the long haul. He looked back over, 57 years up to 1972 and saw that pattern hold.
That long view, it seems critical for keeping your sanity when things get choppy short term.
It really is.
Now, Graham made a very famous distinction between investing and speculating. What's the core difference there in his view?
For Graham, investing is quite specific. It's an operation that, first, is based on thorough analysis.
Okay, analysis.
Second, it promises safety of your principal, getting your initial money back. And third, it offers a satisfactory return.
Analysis, safety, return. Got it.
If an activity doesn't meet all three of those criteria, then in Graham's book, it's speculation.
So speculation is basically anything else, anything lacking that solid groundwork.
Pretty much. He saw it as much closer to gambling, really. Yeah. And like gambling, the odds ultimately favor the house, which in this case is Wall Street. Speculation might feel exciting.
Sure, the thrill of the chase.
But Graham called it the worst imaginable way to build wealth. Just not a reliable path.
But didn't he have that interesting take on investing being like a unique kind of casino?
Yes, that's a great point. He argued that investing, done right, is like the only casino where you actually can't lose in the end, provided you follow the rules that give you an edge.
Because you're stacking the odds in your favor.
Exactly. He famously quipped that investors make money for themselves, while speculators, well, they mainly make money for their brokers through commissions and fees.
Ah, that explains why the fast-paced trading gets so much hype sometimes.
Precisely. Wall Street often plays up the excitement, downplaying the, let's face it, sometimes boring virtues of patient investing.
Okay, that makes sense. Let's dig into one of his absolute cornerstone ideas, the margin of safety. What is that, and why did he think it was so crucial?
Right, margin of safety. It's fundamental. Basically, it means buying an asset for significantly less than what you estimate its real underlying worth, its intrinsic value to be.
Intrinsic value, like what the business is actually worth based on fundamentals.
Exactly. Assets, earnings power, that sort of thing. What a smart, informed buyer would pay. This approach, buying with that built-in cushion, is what Graham believed leads to handsome rewards over time. Think of it like designing a bridge to handle way more weight than it'll ever likely carry.
So it's really about getting a bargain, buying low, aiming to sell high, the classic advice.
It is. And Graham practiced what he preached. He gave an example from 1925, Northern Pipeline Co. It was trading at $65 a share.
Okay.
But he figured out it held bonds worth at least $80 per share. Huge gap. So he invested, pushed for a higher dividend, and eventually made a really nice profit.
Wow. Finding hidden value.
Yes, and it's the complete opposite of what he saw as Wall Street's tendency to chase trends, buy high and sell low, driven by emotion instead of value.
And the margin of safety isn't just about finding that initial good price, right? It also acts as a kind of buffer.
Absolutely critical point. Even with the best analysis, prices will go down sometimes. That's just markets. The margin of safety acts like a shock absorber. It helps cushion those drops and drastically cuts the risk of a permanent loss of your capital.
Okay, so to be an intelligent investor, think long term, no investing isn't speculating, and always demand that margin of safety. What about common mistakes? What pitfalls did Graham warn people about?
Well, one big one is assuming that just because a company has, obvious prospects for physical growth, like it's in a hot industry or expanding rapidly, that this automatically means big profits for investors.
Ah, the growth trap. Sounds familiar. Like the dot-com era, maybe?
Exactly. Graham's warnings feel incredibly relevant looking back at the dot-com bubble and bust. Jason Zweig highlights this. People chase the obvious growth of internet companies.
And got burned badly.
Many did, yes. Funds like the Monument Internet Fund became cautionary tales. It just shows that a good story or lots of hype doesn't guarantee investment success. You need the value underneath.
And it wasn't only about avoiding hype, was it? He pointed out that even some seemingly clever strategies could fall flat.
Right. He mentioned the foolish force stock formula. Looked great in back tests, apparently, but didn't work out so well in the real world.
Interesting.
He also noted how special situations, like betting on mergers, became less profitable over time because, more people started doing it. Competition increased.
Makes sense.
Yeah.
And the big one, trying to time the market.
Oh, yeah. He was definitely not a fan of market timing. He constantly stressed how incredibly difficult, maybe impossible it is to reliably predict the peaks and valleys.
You just can't know the future.
Exactly. He even used Alan Greenspan's very bullish forecast in early 1973 as an example. Greenspan was optimistic right before a major market slide. It just illustrates how futile market timing usually is. It's mostly a loser's game.
Okay, so steer clear of those traps. For someone wanting to be what Graham called a defensive investor, someone prioritizing safety, avoiding big mistakes, what were his basic recommendations?
For the defensive investor, rule number one is diversification. Don't put all your eggs in one basket, basically. Spread your investments around.
Makes sense. What else?
He also strongly advised including bonds in the portfolio. He talked about considering taxable versus tax-free bonds, different maturity, short-term versus long-term. He even gave specific yield examples from 1972 to illustrate.
So balancing stocks and bonds.
Yes. And he saw U.S. savings bonds as potentially useful too, mainly for their safety.
What about actually picking stocks, though? If a defensive investor does want to own individual stocks, what should they look for?
Graham had clear guidelines. Stick to large, prominent companies, household names, essentially. They should be conservatively financed and have a long, uninterrupted history of paying dividends.
What did he mean by conservatively financed? Less debt.
Pretty much. His rule of thumb was, for industrial companies, common stock equity should make up at least half their total capitalization. For utilities or railroads, at least 30%. It's about ensuring the company isn't overloaded with debt, giving it a buffer if times get tough.
So solid, established companies with good track records and strong balance sheets.
Exactly. And he also suggested that for many defensive investors, simply using well-established mutual funds or similar pooled investments was a very sensible approach. It gives you instant diversification and professional management.
Takes some of the individual stock picking burden off. What about buying strategies, like dollar cost averaging?
He was a fan of dollar cost averaging, yes. Investing a fixed amount regularly, regardless of market ups and downs. It averages out your purchase price over time.
So you buy more shares when prices are low, fewer when they're high, automatically.
Right. And crucially, he warned against getting sucked into active trading, especially with how easy online trading became. He basically advocated for setting up an autopilot portfolio and then leaving it mostly alone. Resist the urge to constantly tinker or speculate.
Don't let the ease of clicking buttons turn you into a gambler.
That's the essence of it, yeah.
Now, growth stocks. They always seem so tempting. The next big thing. What was Graham's take on those for the defensive investor?
He was generally pretty wary of them. He pointed out that growth stocks often trade at really high prices compared to their actual current earnings or even past earnings. That high price injects a big speculative element.
You're paying a lot for expected future growth that might not materialize.
Exactly. He used examples from his time, like IBM and Texas Instruments. We could easily update that today with, say, Microsoft or Cisco in the early 2000s. These were dominant companies.
Right. Looked unstoppable.
But they still experienced massive price drops. It just showed that even for the best growth companies, there's significant uncertainty and risk baked into those high valuations. So for the defensive investor, he felt growth stocks as a group were just too risky.
Really underscores that focus on tangible current value over potentially fleeting future promise. Another thing Graham stressed was actually understanding a company's financial statements. What should investors watch out for there?
Yeah, you can't just take the headline numbers at face value.
Hmm.
He warned specifically about things like special charges that companies might use to, shall we say, massage their reported earnings per share.
Making things look better than they are.
Potentially, yes.
Yeah.
He also mentioned other accounting details that can make comparisons tricky, like how companies use tax-long carry-forwards or different depreciation methods like straight line versus accelerated. It affects the reported profit.
So you need to look under the hood a bit.
Definitely. Graham emphasized distinguishing between a company's value based on its past performance and track record versus its current stock market price. And he urged caution with companies relying heavily on OPM, other people's money.
Borrowed money, basically.
Yeah, lots of debt or financing activities shown on the cash flow statement can be a red flag. It's about understanding the real financial health, not just the surface story.
Makes sense. It's like doing your due diligence as an owner. Speaking of owners, what about the relationship between shareholders and the company's management? What did Graham think was important there?
He believes shareholders really need to pay attention to how well management is actually running the business. Are they efficient? Are they genuinely acting in the shareholders' best interests?
Like, are they treating the owner's money responsibly?
Exactly.
Yeah.
He even went so far as to say the burden of proof should be on the company to explain why it's not paying dividends. He felt returning profits to owners should be a priority.
Interesting take.
He was also pretty skeptical of companies that constantly split their stock. He saw it often as just a gimmick to hype the stock price, like cutting a pizza into smaller slices. You don't actually have more pizza.
Right, it doesn't change the underlying value.
Exactly. And fundamentally, he stressed the importance of actually reading the proxy statements. That's where you find out what management is proposing and voting on. Be an informed owner.
Being an active, informed owner is part of being an intelligent investor.
Got it. Now, circling back to the margin of safety, you mentioned his 1972 perspective was particularly telling for the time.
Yes, it was quite insightful. In 1972, Graham looked at the market and observed that the earnings yield on stocks, basically the earnings per share divided by the stock price, was much lower compared to the interest rates you could get on bonds than it had been in earlier years, like, say, 1965. So stocks looked expensive relative to bonds.
Relatively speaking, yes. His conclusion was that the overall margin of safety in the stock market as a whole was significantly smaller, maybe even non-existent or negative at that point. It really highlights how market-wide valuations matter for your potential safety cushion.
The whole environment can change the risk level. Okay, finally, there's that appendix section on the super investors of Graham and Doddsville. What's the key takeaway from that?
Ah, yes, the super investors. It's basically Graham providing real-world proof. He showcases a number of investors who consistently followed his and David Dodd's value investing principles over many years.
And they got amazing results.
Exceptional long-term results, yeah. The core message is that their success wasn't just luck or random chance. It came from applying a logical, disciplined framework, the framework of intelligent investing.
So it's repeatable in principle.
That's the argument. These investors focused on buying businesses, not just trading stock tickers. They looked for discrepancies between market price and intrinsic value. He gives the example of the Washington Post Company in 1973. Its stock price was way below what its actual assets were likely worth.
Buying dollars for 50 cents, essentially.
That's the goal. It's powerful, real-world validation of the principles.
Definitely. Okay, so for our listener, the learner who's trying to absorb this quickly but deeply, what are the, say, 3 to 5 absolute must-remember principles from Graham?
Right. For the learner, boil it down to this. 1, think long-term, accept market ups and downs as normal. 2, know the huge difference between investing, analysis, safety, return, and speculating, basically gambling.
Okay, long-term investing, not speculating.
3, always demand a margin of safety. Buy below intrinsic value. That's your buffer. 4, remember what intelligent means here. It's about character patience, discipline, emotional control, thinking for yourself, not raw IQ.
Long-term, invest versus speculate, margin of safety, and character over brain power. Great summary.
Those are the big ones, I think.
Really solid, timeless advice. So here's a final thought maybe for you, the listener, to chew on. Graham wrote this decades ago. Markets have changed, technology's changed drastically. How do these core principles still hold up? And maybe more importantly, what does an intelligent investor today need to be especially mindful of in this fast-paced world? Something to think about. How do you adapt these classic ideas?
It's a great question. And really, this deep dive is just, skimmed the surface. Graham's book, The Intelligent Investor, offers so much more depth. If you want to keep learning, it's still an incredibly valuable resource for navigating today's investment world.